Does the 401k plan no longer make sense? Maybe not, according to a recent Bloomberg article and several others that have surfaced lately in the news. It's a bit shocking to read, as retirement plans have long been considered one of the best ways to save for retirement. Today, we're going to be exploring how you can unlock the true potential of your 401k and discuss what we have identified as the 5 major misconceptions of 401k plans. We want to make sure that you're taking full advantage of all of the benefits offered in your plan. Hi, this is Kari Wolfson, and I'm an account executive and certified financial planner here at Advisor Investments. We're here with another Advisor You Can Talk To podcast. Today, I'm joined by 2 of my colleagues, Andrew Busa, a senior financial planner and certified financial planner, and Matt Shoemaker, an account manager. Welcome to you both.
Good to be here. Yeah, I'm looking forward to getting into this one. Just talking about the articles that you mentioned, Kari, that have recently come out, sort of against 401k plans, and we'll see that throughout this episode, there's been some oversimplification there, and we're looking forward to digging into that. And I can't wait to get into those misconceptions that you mentioned either.
I completely agree, Andrew. And first off, just want to thank you, Kari, for the introduction and letting us join you on this podcast. Looking forward to discussing some little known features and benefits of 401ks, such as the various myths about how they're taxed. As you'll hear, we're big believers in the value of 401ks. We use them ourselves at Advisor Investments, and we think they're a smart, simple savings tool for people both young and old. One striking statistic that stood out to me was that only 32% of Americans are taking advantage of 401ks and investing in one, while nearly 59% of Americans have access to them.
Perfect. Now let's get started. Before we discuss the 5 major misconceptions of 401ks, let's begin with a few of the basic things to keep in mind when you are initially signing up for a 401k plan. Andrew, can you get us started?
Right. So there are really 3 basic things that you want to find out immediately when you either first sign up for your 401k or you first get hired at a new job. So number one is know the ground rules. So this means understand if there's a company match available to you, because that's free money that the company is offering you. So you want to take advantage of that. And also know what the participation investing rules are. So certain companies, certain plans, you might need to be there for a certain amount of time before you can even participate in the plan. And then for vesting, you may need to be an employee there for a certain amount of time before all of that money is really yours if you were to leave. So know the ground rules. Number 2 is educate yourself on what the investment options are. And this is going to vary from plan to plan. No, Matt, you've done some research on this and have some actually surprising statistics to share.
There was a study done a few years ago, and on average, a 401k plan has about 10 options. And while for some people this might be exactly what they're looking for, it's very simplified and easy for you to pick a few options. A lot of investors might be looking for more options. And that's where this thing called the self directed brokerage option comes into play. And what this does, it unlocks your 401k and opens you up to a wider universe of funds that you can use. It still has all the same principles of a 401k, but it pretty much allows you to invest in any stock, bond, mutual fund, ETF type investment product that you typically would have access to in a brokerage account. And with that, it increases your options and allows you to speak with your advisor and maybe help to develop an investment strategy using funds that they would recommend that you typically wouldn't have access to in your 401k. And something that we found too is 77% of 401ks are actually invested in what's called the target date fund. And the target date fund is it is a fund that has a retirement date set out in the future. And so, for example, if you're a younger employee, you're working, you might plan to retire in 2050. And so, companies like Vanguard will have a Vanguard 2050 retirement fund that will start aggressive as you're younger, and the mix will be more towards equities as opposed to fixed income. And as you near retirement, that mix will shift, and your fixed income portion of the account will grow more, and then the equity portion will shrink. And so, while we think the target date fund is good for some people, it may not be good for others. And so, that's where that self directed brokerage option comes into play, especially when a lot of 401ks, the only option you would normally have is that target date fund.
Yep. So again, that's why just knowing what your investment options are up front are so important. And if you have this brokerage option available to you, just knowing that is super important. And then number three, the third basic thing to know, just know what the fees of your plan are. So, for example, that brokerage link will have a fee associated with it. Of course, there are going to be fees with the underlying mutual funds that you're considering for your 401k. And then your 401k plan may also be paying some sort of an advisory fee if that's the arrangement that they've set up. So just knowing all of that is important. So again, those three basic things to find out immediately. Number one, the ground rules. Number two, the investment options. And finally, know what the fees of your plan are.
Exactly, Andrew. Now let's move on to our 5 misconceptions. These are some of the most common issues that tend to trip people up when they are thinking about their 401k options. The first misconception is that you can only put pre tax money into your 401k. Andrew, what are your thoughts?
So that first misconception is really a good one, Kari, and I don't see this mentioned in the articles that you talked about at the beginning of this podcast. Is that in these articles, it's kind of assuming that all the contributions that you're making are pre-tax, meaning you're making contributions to a traditional 401k, and what that means is that the contributions are deductible against your current year taxes, meaning you're lowering your taxable income. What's becoming more common, though, is that Roth 401k options are being offered at a lot of these 401k plans. So, why that's important is that let's say that you want to make a contribution to a Roth IRA, but you find that your income is too high. So, there are phase outs that can get hit pretty early on once you start earning a good amount of money that you wouldn't be able to contribute to a Roth IRA. Uh, so, what's special about a Roth 401k is that there are no income limitations. So, no matter how much you're earning, you can put money into your Roth 401k if it's offered to you. And so, once the money is in there, it's growing tax deferred, and then any withdrawals that you make are tax free once you're able to do that. Of course, there's no deduction on the way in, but it's good to have that tax diversity sort of on the other end when you reach retirement.
That's huge because a lot of people, they see Roth and they just assume that if they're over the income limit, they can't make the contributions. So
Right.
it's, really important to point out that there are not income limits within the Roth 401k option. That's huge.
Exactly. Yep. And there's no required minimum distributions for a Roth IRA or a Roth 401k when you hit that age. Right now, it's at 72. So that's just another advantage of that.
That's right, Andrew, and we believe Roth money can be extremely valuable as a legacy piece. Not all plans offer the Roth 401k, but we would encourage you to explore your plan documents and capitalize on this offering if available. You can actually split your contributions between both Roth and traditional, and it wouldn't look any different to you from a logistical standpoint.
Yeah, and that's an area where you'll really just look at it from year to year to decide what's most beneficial to you, right? It's going to vary depending on how much income you're making. That's something to definitely check with your advisor on, talk to your CPA about it. But in these articles, taxation was sort of one of the major criticisms over why 401k plans aren't the best choices anymore. Even though taxes are historically lower today than they have been in the past, meaning the benefit of making a traditional 401k contribution is diminished because the benefit is of course based on your marginal tax bracket for the current year. So these articles were looking back to the 1980s when taxes were a bit higher. The 401k, it's still advantageous whether you're making traditional contributions or Roth 401k contributions. It's just going to depend on what your tax situation is for a given year.
And I think Matt's point that you can split it between the two, you don't have to choose one or the other, and
Mm,
it's flexible. You can change it year over year. I know when we're doing financial plans and working with our clients, it's not something where you set it in stone. You can change it over time. So if you do have that option, it is definitely something to consider.
it's a great point.
All right, moving on to the second misconception, which is you can only contribute money to a 401k from your paycheck.
So there are other options for you to get money into your 401k. I'm sure a lot of people listening to this podcast right now have been employed with other companies in the past that they had 401k plans with, and those plans may still be sitting with their former employers. And there are options for a lot of plans that will allow for roll-ins. And so what that does is it allows you to consolidate your 401k plans, continue that tax deferred growth with that pre-tax money. It's not taxable to combine 401ks. And really, like I said, one of the biggest benefits is that consolidation. So you only have to look at one plan.
Yeah, and a caveat just to throw in there too, Matt. If you're considering a rollover from a 401k to an IRA, you also want to know a little bit about what's called ERISA. So that's Employee Retirement Income Security Act. Basically, what this does is it gives your 401k some additional creditor protection, meaning if you're subject to a lawsuit, if there's bankruptcy, your 401k has this special protection granted to it. And basically, when you roll from a 401k to an IRA, you're losing that ERISA protection. Now, IRAs do have their own measure of protection. That's going to vary from state to state. Um, so that's just something to keep in mind if it's especially if it's a large 401k rollover, just something to know. And your advisor should educate you on that if they haven't.
All great points. So, on top of your deferrals and employer contributions, you can also transfer old 401k money and, continue to keep these additional benefits. The third misconception that we want to talk about is that you can only contribute up to the yearly maximum.
This is a really good one and one that really doesn't get much press, but even with just what you said there, Kari, you can only contribute up to the yearly maximum. Sounds reasonable. So what we're talking about there are the contribution limits, which are indexed up every year. And we're not going to apply hard numbers just because we want this to be somewhat evergreen and last and be relevant. But so you have those yearly contribution limits, but you also have what's called these Section 415 limits, which are much higher. Now, if your 401k plan allows for what's called after tax savings, you could theoretically contribute up to the yearly contribution limit and then contribute a much larger amount as after tax to get up to that Section 415 limit, which again is a much higher amount. Well, why would anyone want to do that? So, what you can then do is take that after tax contribution that you just made, and if your plan accepts in service distributions, you can take that amount of money and roll it right into a Roth IRA. So that means you could theoretically put a very large amount in 1 year into a Roth IRA if your plan allows this. So, this misconception and this information it's really aimed at a small slice of listeners out there because you need to have the cash flow on a yearly basis to be able to do this, and your plan needs to also accept after tax contributions as well as in service distributions. So this is an advanced strategy and not for everybody, but if you're able to do this and you have the cash flow to do this, it's really something to consider because you can supercharge a Roth IRA very quickly over a few years if you're able to get that money in there. So if you have questions about this, definitely talk to us, your advisor, your CPA. This is a really really cool strategy.
Andrew, yeah, I've seen that referred to as the mega backdoor Roth, and that is a great way for you to increase those contributions each year. And the IRS does come out with contribution limits, and they are adjusted for inflation each year, and they are greater than IRA limits. So it's a great way for you to get pre-tax and tax-deferred savings to build up your retirement funds. And if you are over the age of 50, you can contribute an additional $5,000 per year, and that's what's known as a catch-up provision, and it's a great way, again, for you to increase that retirement savings.
Matt, those are all important things to point out. And I also just wanted to remind anyone who's listening that we do put out those IRS updated limits each year in our key financial data fact sheet. And you can find that linked to the podcast description. The next misconception to talk about is that you can only access your 401k money once you're retired.
Car, I think this is a great misconception to discuss because the purpose of a 401k plan is to save for retirement and to end up using those funds in retirement. But for a lot of people, it's tough for them to shell money away and not be able to touch it for 40, 50, 60 years, however long out you're going into retirement. So there are ways to access your money. They may not be discussed in your general plan documents or with your plan administrator. Two common ones that you'll run into are what's known as a loan or a hardship withdrawal from your 401k. The loan is exactly what it sounds like and would be similar if you were to go to your bank, except in this scenario, you're tapping into your 401k balance. We don't recommend this necessarily because you do have to pay back interest over time. This interest would come out of your paycheck and it would be taxed and then put back into your 401k. And although it does go back in there, again, you do have that interest expense that you then have to pay. And not all plans offer loans. So that's something that you'd have to speak with your plan administrator about. The second option is what's known as a hardship withdrawal, and this can only be used for heavy financial needs. And again, not all plans offer this, but it does enable you to take money out prior to your full retirement age if you do run into a scenario where you do have that heavy financial need. One thing to remember with hardship withdrawals is that you are immediately taxed on the money as soon as you take it out, versus a loan, you do have that grace period since you're just borrowing the money that you aren't immediately taxed on it.
Okay, so it's kind of worst case scenarios, but good to know that there is the option if you did need it versus thinking that it's just locked in there, kind of regardless of the situation.
Exactly. And now another option to access the money is what's called the Rule of 55. Now, the Rule of 55 comes into play if you leave your job after the age of 55, whether by choice or some other variable that comes into play. So it gives you the opportunity to take money out of your retirement plan without penalty. And so normally there would be a 10% penalty if you take out any money until you turn 59 and a half. But you can use this Rule of 55 to take money out and use those funds as a bridge between starting a new job or anything that you would need the funds for.
Yeah, this is huge. I think especially if someone does get laid off and they're close to retirement age, they're, worried that will they be able to find another job or might need some supplemental income. It's nice to know that, you actually can take the money out from your 401k with this rule of 55 without paying a penalty.
Exactly, exactly. And then the last way for you to get money out would be what's called an in-service distribution. And this typically occurs with people who are currently working. And if the plan does offer it, they can roll over a portion of their retirement plan into an IRA for whatever reason, if they do need the funds prior to their retirement date, or if they would like to increase their investment options.
Yeah, no, that reminds me of someone we were working with. She had limited options in her 401k, and the plan did offer an in service distribution where we were able to roll that money into an IRA so we could manage the account for her with more investment option flexibility. And she was still able to make contributions that were going into her existing 401k. So, definitely all things to consider, but probably on a case by case basis. So, best to speak with your advisor and CPA.
Yep, for sure. And then another one just to throw in here is that, of course, the money has to come out at some point, right? For required minimum distributions, if you're talking about traditional 401k contributions here. But if you're continuing to work beyond RMD age, which right now in 2020 is 72, and you are not a 5% or greater owner of your company, you can actually delay those RMDs until you're done working. So that's an advantage just to keep in mind when you're thinking about how and when to access your money once you reach retirement age. You could leave the money in there to keep growing tax deferred.
Great point. So if you're continuing to work and you don't need the money, why pay the taxes?
Exactly.
All right, well, we're on to misconception 5. I can only have a 401k if I work for a large company.
This is an important one. And again, it's becoming more common. We're seeing this more frequently. And what we're referring to here is that if you are starting your own business and you're set up as a sole proprietorship or an LLC or some sort of an S corporation structure, and you are the only employee, or it's just you and your spouse, you could also be eligible for this. You may be eligible to set up a solo 401k plan. So just because you're not working for an employer doesn't mean you can't have a 401k plan. So that's important because all of the benefits that we've been talking about throughout this episode, that comes with Roth options, it comes with catch-up provisions, ERISA protection, right? All of that comes with the solo 401k. And if you're able to do this, this is really something worth exploring Um, you know, you also could have the option of a SEP IRA, and these are both good options to consider. The SEP also allows you to put a large amount of money in to a retirement plan in a given year. Generally, the solo 401k is going to be a bit more flexible than the SEP on a year-to-year basis with how much you can put in. Um, and again, of course, you have those catch-up provisions with a solo 401k once you reach the age of 50. So keeping that in mind, we had a client that we were helping who they weren't currently eligible for a solo 401k. They were going with the SEP just because of how their business was structured. But they were thinking of doing some restructuring over the next couple of years. So we just told them, hey, keep in mind that you may want to consider transitioning to a solo 401k at that point, just because of the flexibility that it offers. So if you are eligible for this, if you think you might be down the road, keep this in mind. Keep us in the loop. Talk to your tax advisor, and we're happy to help with this one.
Yes, that's an excellent benefit that many people may not know about. So, if you are starting your own business or are a sole proprietor, this is definitely an option you should look into. Now, Andrew and Matt, we've covered a lot of ground here. Before we close, I'd ask you to mention a few of the takeaways from our discussion. What are some important points for people to remember?
I would say just watch out for headlines. We've talked a lot about the different nuances that come with 401ks, and let's face it, nuances often don't make it into the headlines. So understand what works for your personal situation, and you're going to do that by talking to your advisor, talking to your CPA. We've kind of echoed that throughout the podcast. So take those articles with a grain of salt.
That's great, Andrew. And both to echo your sentiments and then to respond to the article that you referred to at the beginning of the segment, Kari, I think the 401k plan does make sense and it has a lot of valuable tools and benefits. I think one thing to remember too is that the 401k is not set in stone. It's constantly changing, as we saw with the introduction of the Roth option in 2001. And although, as Andrew talked about, the tax benefits may not be as great as they once were, they're still very valuable to a lot of people. And it's a wonderful way for you to build up your retirement savings over time and to focus on that tax deferred compounding growth.
Yeah, no, I think that's great. What's better than automatic savings? You don't have to think about it. You're continuing to grow your money, so it's such a important tool for retirement, and the articles can be misleading, so do your own research and take them with a grain of salt. Right, great. Well, this is Kari Wolfson from Advisor Investments. Thank you for listening to the Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe and review our show. You can also check us out at www.advisorinvestments.com/podcasts. Your feedback is always welcome, and if you have any questions or topics you'd like us to explore, please email us at info@advisorinvestments.com. Andrew and Matt, thanks again.